When you say a good return, just this is a very like technical question, I guess, maybe to bring it to this, but like, let me tell you why I'm asking this, because I've found people that are like, well, for me to get investors money, I have to give them like 20%. And I'm like, no, you don't. There's money sitting in a savings account. But like, what do you consider like right now? Like, let's just say I was going out and raising money from either friends or family, or maybe a couple close investors. How do I have to structure that deal? What do I have to pay them? What does that look like? What could it look like?
It all depends on who you're asking this question to. If you're going to go and ask this question to Warren Buffett or Ray Dalio, like one of the greats who really knows what to do and how to place money, their answer is going to be totally different. Whereas if you ask your grandfather or something that's not very tech savvy, and he has his money sitting in the bank and he hasn't really done investing before, and he doesn't really understand the risks of what you're doing, then he might say 5 or 8 or 10%, right? And it's, I think it's a little bit of a dance where the investor doesn't really, unsophisticated investors like that don't really know what a good return is. All they know is what they're getting currently from either the stock market, their average over the last couple of years, or what they're earning it from their bank account. And so I think that's why maybe unsophisticated investors kind of hop into these kind of opportunities, because they don't understand the risks, and they actually don't have any other opportunities that are returning a certain amount. So when I think about the first investors that I raised money on for co-living, they were from 4 individuals. I raised a total of $200K. This was back in, 2019. And
you knew these people? They were like friends.
Yeah. And I made a Facebook post online, and I was like, hey, I'm running an experiment. I have this portfolio of 4 homes. They've been returning this much. I'd like to try out a strategy where I, use other people's money to fund the down payment of the homes, and I will pay 8% interest. And I kind of just stuck, a dart out there, and I had a couple people jump. And so, I think it was because over the years, for like as long as I've been an adult, I've been building in public. I've been showing, hey, here's what my returns look like. Hey, I bought this property. Hey, here's, in the last year, here's what my properties returned. And arguably, I haven't done as much of that lately. And this is a good reminder to myself to do more of that, because that's how you build trust with people in your network. And, whereas if I go to a sophisticated investor that invests in these syndications and funds, they're investing in institutional quality things, and they understand the risk adjusted returns, and they understand, when I put money into this fund, I'm, 0.5% of all capital that this fund's using, and, all the risks are clearly defined. And so, trying to raise money from someone like that, who already invests in a bunch of different deals and has access to high institutional quality people, that I would say you're barking up the wrong tree if you're first starting. And so I'd hate to say it, but you probably, if you're in the beginning phases of this and you haven't done it before, you're probably raising money from non-professional investors.
Yeah, man, that's such a great reminder to, as we're learning, I think is even like, maybe some of my students are even listening to this episode, where it's like, if you're learning, you're doing something, like it puts a whole new positive spin to using social media to build social proof in you and what you're doing.